Right. So here in Lincoln County, Maine, our towns face a lot of challenges, and there is a lot of opportunity. We feature a lot of historic buildings that are in need of affordable housing, and we need a lot of affordable housing options. So this webinar will provide helpful information about one of many tools that can help enhance efforts to develop more housing. Additionally, the tax credits that we're going to talk about can help stimulate economic activity through commercial enterprises and enhance the beauty of our towns. However, accessing these tax credits can be challenging, so we hope this webinar will shed some light on how that can be done. This effort, so this webinar builds on our previous work at the Planning Commission related to housing, including a 2023 Affordable Housing Needs Assessment, which determined that the county needs approximately 1,365 additional housing units to accommodate our anticipated job growth in the county and population growth within the county. It also builds on many other subsequent initiatives we have led to help activate more or actively move the needle in our goal to increase housing opportunities in Lincoln County. As I mentioned, today's webinar will focus on historic tax credits, and it'll feature 5 expert panelists. Each of our panelists here today will speak about their roles in historic tax credits and their unique and complementary value to the process. We'll hear from our guests until about 4 o'clock or so, at which time we will open up the webinar for questions. And if you're comfortable at that time, you can come off mute to ask your questions, or you can put them in the chat. But please save your questions until that time, so that our panelists can have time to share all the material that they want to share with our audience. We hope this webinar will help more folks think about this tool and perhaps other tools as well in the quest to preserve historic buildings and stimulate housing development and economic development as well. As far as housekeeping goes, I ask that everyone stay off mute. I've muted all of you upon entry. We will be monitoring the chat, so if you need to ask a question, do feel free to put that in there. But like I said, we won't be answering any questions until the latter part of this webinar. And at that, I will turn it over to our panelists. We'll start with Mike Johnson of the Maine Historic Preservation Commission. After that, we'll hear from Ryan Green of Coastal Enterprises, Inc., otherwise known as CEI. And then we'll hear from John Egan from the Genesis Fund. And then Carter Jackson of Jackson Preservation. And then finally, we'll hear from Tara Kelly of Maine Preservation. So at that, let's get things started. So Mike, I'll hand it off to you.
Thanks, Alex. So my name is Mike Johnson. I'm the tax credit coordinator for the Maine Historic Preservation Commission. It's actually called the Historic Rehabilitation Tax Credit Program. Our office is the Maine State Historic Preservation Office. We're the first point of contact for any inquiries about the tax credits or National Register nominations, review and compliance issues. We assist in technical advisory type things with historic properties, and we do surveys, architectural and archaeological surveys, and a certified local government program. So that's essentially what our office does in a nutshell. It's actually a little bit more than that, but keep it short. So I was going to talk about both the federal and state historic rehabilitation tax credits today. So the federal rehabilitation tax credit is 20% credit on qualified rehab expenses in the rehabilitation of a historic property. In order to qualify for the program, the expenses have to exceed the adjusted basis of the property. The building has to be listed or eligible for listing in the National Register of Historic Places. Ultimately, it's going to have to be listed in the National Register, or it can be found to contribute to the significance of a National Register listed district or a certified local historic district. Buildings, in order to qualify, another qualification for the credit is that the buildings have to be used for income producing purposes. They can be used for, for housing a business or apartment complex as a rental property. And all of the rehab work has to be reviewed and found to be in accordance with the Secretary of the Interior standards for rehabilitation. Those standards are kind of the most flexible of standards, and I'll get into those a bit more soon. Um, it's a complex program that involves overlapping National Park Service and Internal Revenue Service regulations. So it's important to get the right team members involved and to do your homework on the program to make sure it's going to be of use to you. I don't want people to get wrapped up in putting together a whole application and all that, and then find out the project's not going to do what they thought it was going to do, or the program isn't going to do for them what they thought it would. Um, and with regard to the federal tax credit, the National Park Service ultimately has to approve all of these projects. Our office is the lead agency for information and for reviews and consultation, but they have the final kind of approval authority for those. So the state historic rehabilitation tax credit, we have two different credits. One is a substantial rehabilitation credit, and that essentially piggybacks onto the 20% federal credit. The state credit is a 25% credit on all your qualified rehab expenses. The projects have to go in order to qualify for the state substantial rehab credit. Basically, an applicant just has to go through the federal application process for this, addressing all the things I just talked about with regard to the federal program. And if they qualify for that, they automatically get an additional 25% state tax credit. So it'd be a total of 45% credits on your rehab expenses. The other credit we have is called a small project rehabilitation credit. And that's a 25% credit on smaller projects that have rehabilitation expenses of between $50,000 and $250,000. The project has to be exactly between those numbers. It can't be 251,000. It has to be between 50 and 250. That's the way Maine Revenue Service has interpreted the legislation for that. So that's what we have to stick to on that. And other than the substantial rehabilitation requirement, which is not required for the standalone state credit, all the other federal requirements that I went over generally apply to this credit as well. And our office is the sole reviewers and has the approval authority for those credits. There's also an increased credit for affordable housing, which right now is an additional 10%. So you would get, rather than a 25% credit on rehab expenses, you would get 35% state credits on your rehab expenses. And there's a $5 million per project cap, but there's no overall program cap. And there's also some legislation that passed this year. Actually, just this past June, there's an extra 10% tacked onto that in rural areas. In municipalities with less than 12,500 residents, if it's a residential project. It doesn't have to be affordable housing. If it's simply a residential project, you get 35% in state tax credits. And then there's an additional 20% added in rural areas if it's also an affordable housing project. So you could potentially qualify for 20% in federal credits and an additional 45% in state tax credits for a total of 65% of your credits on rehab expenses, which is pretty incredible. There is a $10 million per project cap in the first 2 years of these projects. So that's kind of, it was 5 million per year. It's now 10 million for the first 2 years, which allows developers to spend more money on the front end of these projects and get them into service sooner was the intent behind that. Um, so I had mentioned the National Register of Historic Places earlier. That is a list that's the National Park Service's official list of properties that are deemed worthy of preservation because of their historical significance to American history, architecture, archaeology, engineering, and culture. And that's a requirement. All these properties have to be listed in the National Register to qualify. Um, all of the projects have to meet the Secretary of the Interior standards for rehabilitation. Those standards provide directions in making appropriate choices for these buildings based on their architectural style, their materials, for repairs, for new additions to the buildings to make sure that they're complementary to the historic buildings and don't detract from them. All these things may be part of a rehab project. Um, the standards are regulatory for the Historic Preservation Tax Credit Program, and they're the most often used regulations by local historic districts in the country. Um, so, as far as the review process goes, uh, it's a three-part application. Part one is essentially establishes whether or not the building is historic and eligible for the National Register, and that provides all the historic information on the building that we need to review to make that determination. We have 30 days to review it at our office, and we would consult with whoever the applicant is on that to help them get the needed information in and to do that assessment. And then that gets forwarded on to the National Park Service where they have an additional 30 days to do the final sign off on those if it's a substantial rehab credit. The part two is basically the same review period. It's 30 days at our office and 30 days at the National Park Service. That review usually involves, what the nuts and bolts of the project are going to be, how the building is going to be rehabilitated. They're going to involve architectural plans, specifications. They may involve engineering and that type of thing. We're going to look at all that stuff to make sure it's done in accordance with the Secretary of the Interior standards. And again, we review it at our office. And if it's a substantial rehab credit, we're going to forward it on to the National Park Service for their review and their final approval. All of these go with photo documentation. So all these buildings have to be photographed inside and out. This review covers the interiors and the exteriors, so extends beyond what maybe a local review commission might review for these properties. It also involves any new construction that might be involved, any site work, any of that stuff. So it's very important that these buildings be thoroughly documented inside and out prior to undertaking any work on them. Because if you begin work without this documentation in place, you may be disqualified from being allowed these credits at all. And then, so when you have your part two approved, which, tells us what you're planning on doing with the building, you can go forward to construction and rehab the property. And the part three is basically documentation of the property after the work is completed. Excuse me. And that just shows us that you did all the things on the building that you said you were going to do. And then we review that. Same 30 days at our office, same 30 days at the National Park Service, and hopefully you get a final sign off. And when that happens, you're basically eligible to claim the tax credits. One thing I'll mention is parts one and two can be submitted concurrently. They can be submitted together so that 30-day time frame is condensed, so we can review both those applications within the same 30-day time frame, and the Park Service does the same thing. I generally tell people just don't begin construction until you have the approvals in place. Every now and then I get a call from somebody who wasn't aware of the program. if the building is documented before the work takes place, you may still be able to claim to get into this program and qualify and claim the credits. But if it's done without any documentation in place and the building is not individually listed in the register, you may be out of luck. Um, it's been a very successful program so far. We've had over 200 rehab projects that have been certified or that are currently under construction since 2008. And I am available to answer any questions anyone might have. I'm glad to put my contact information out there. You can look me up on the internet. Uh, Alex, I don't know if you want me to give you the contact information now, or I can wait, or you can provide it, however you want to do that.
I'll put it in the chat.
Yep.
So, yep.
Okay. That's all I've got.
Great. Thanks, Mike. Definitely a deep dive into the details of the program, and I appreciate your knowledge. I've talked to you and reached out. You're very responsive, so I feel really comfortable saying that folks can reach out to you and get some questions answered. So thanks for that quick overview of how the program works. Next up, we're gonna hear from Ryan Green, and Ryan's gonna talk a little bit about CEI's investments and historic tax credits. But I don't know, Ryan, if you want to scope out just to give a little bit of an overview of kind of like the type of entity that might reach out for historic tax credits, that'd be helpful. Just some of the basics, and then sort of get into CEI's role. That would be really great. Thank you.
Yeah, sure. So thank you, Alex, and nice to meet everybody. Ryan Green with Coastal Enterprises. We are a community development financial institution based in Brunswick. And we are involved, as Mike just alluded to, on the state tax credit side of these projects as the state tax credit investor. And oftentimes, we get approached by, developers that are looking at, a project, and they more often than not have at least the part one in hand, which, essentially certifies, as Mike said, that the building itself, is, listed individually on the historic register or, in a certified historic district. And they reach out, to discuss the project and, potentially CEI reviewing or coming in as the state tax credit investor, depending on the scope of, what they're trying to do with the building itself. Many of the projects that we look at, are 100%, residential, so new housing units that come online, or what is also pretty common is mixed use development, so some form of commercial, as well as residential redevelopment. And we talk to, developers all across the state, really. We're based in Maine. We only invest in the state tax credits here in state. And really all sorts of developers, many developers are utilizing or undertaking this program for the first time. And on the other side of that spectrum, many developers have gone through this program a number of times. So what we do, I mentioned, CEI, we have a subsidiary, it's called 30 Federal Street Investments, which we stood up back in 2017. And we act as the state tax credit investor in eligible historic projects. To date, just to give a bit of detail on, the work we've done in this space, since we created that subsidiary, again, I mentioned in 2017, we actually had done some tax credit investments prior to the subsidiary being formed, that were done through CEI, the parent. But to date, in this space, we've invested just over 86 million in investments across roughly 60 projects here in Maine. Revitalizing and bringing, many of these old buildings back to life. I mentioned we're a CDFI. We are a nonprofit organization. The state tax credit here in Maine is unique in the sense that it's a refundable credit. So it flows back to the state tax credit investor. via annual refunds from Maine Revenue Service over, essentially 4 equal installments, based on, when the project is completed and ultimately placed in service. And a little bit sort of about our process. So, we as a CDFI, we're very mission oriented. Many, of these historic projects, have inherent mission built into them, particularly from an environmental standpoint, revitalizing these old buildings, making them more efficient. So that's, very much something that CEI is, focused on. But essentially, as the state tax credit investor, the way our process works. So from, an underwriting and review standpoint, and Mike touched on this earlier, really the jumping off point in terms of really getting towards an actual closing is receipt and approval of both parts 1 and part 2 of that 3-part process. Part 2 is, again, essentially what Mike touched on is, the scope of work or the plan of the development, getting signed off on in terms of what you will do to the building itself. And then, our review process and ultimately getting to a closing, 30 FSI as the tax credit investor. At time of that initial closing or construction closing, 1% of our tax credit investment flows into the project, and we subsequently become a 1% member in the project LLC. And then 19% of our equity flows in when the project is at or above 50% completion. So essentially 20% of our equity investment on the state tax credit side flows into the project during construction, with 80% of our investment flowing in upon project completion, receipt of the certificate of occupancy, as Mike mentioned, that approved part 3, right, signed off by the National Park Service, and there's a number of other sort of closeout materials, that are tied to that 80% equity tranche. Another one being the cost certification, which is a document that is drafted by, the developer's accountant, basically, which memorializes or finalizes the QRE basis, or the qualified rehab expenditures, which ultimately drives the tax credit basis for the project and the investors, both on the state and federal side. And one structural item as well that we do offer through CEI, as through our small business lending department here, is, I mentioned, 80% of our equity on the tax credit side flows in upon completion. We have, if there is a need for some additional funds during that construction period, we have provided bridge loans through CEI's lending department, sized at 80% of our tax credit investment. So it's construction financing that is available and ultimately paid off when that final tranche of equity flows in upon completion. It's the way we sort of review these projects, right, on the tax credit side. The underwriting is a bit different in terms of what we really focus on. The project team is really what we're underwriting in these investments, because ultimately, the project getting complete, as scheduled, on time, and within budget, is the most important part from a tax credit investor side, because if you're anticipating completing a project in 1 calendar year and it slips to another calendar year, that's ultimately going to drive when the investor is able to claim that credit. And many of the projects, some of the recent legislation that had just passed last month was touched on earlier. Historically, that annual cap for any project had been 5 million. So, projects that were, anticipating to generate, tax credits above that 5 million threshold, they had typically phased those projects. So phase 1 and phase 2. So in that scenario, phase 1, when that is complete and placed in service, you wouldn't actually get the fully approved part 3 from the Park Service until the full project is complete. But what you would get in lieu of that part 3 for those earlier phases is what's called an interim advisory determination. And So that's sort of just touching on, our process, what we do, where we sort of sit in this program. On the state tax credit side, it's really just identifying a project that, aligns with CEI's mission and what we focus on, from an impact standpoint, and then sort of navigating what that project look like or will look like, the amount of tax credits it's anticipated to generate. Um, you know, Oftentimes, you anticipate what the project will generate from a credit basis going into it, but many times as the work is getting completed and ultimately it's placed in service, projects generate more tax credits than originally anticipated. So it's pretty common for us to include a buffer in terms of what the estimated investment amount might be, just to provide some cushion in the event the project does in fact generate more credits than originally anticipated. And we've done projects, I want to say, in almost every county here in state, and again, we've been doing it for over 10 years now, so we know the program pretty well. Obviously more so on the state tax credit side of things, but still very much involved in the space, and continuing to talk to developers, who might be familiar with the program itself, or new developers who might be sort of, learning about it for the first time, and providing, as much technical assistance as we can in terms of, structure and how everything ultimately plays out. So that is really all, Alex, that I have from CEI's side. But again, as Mike mentioned, I'm more than happy to answer any questions that anybody might have here when we get to that point in the webinar.
That's great. Yeah, thanks so much, Ryan. Really appreciate that. And at this point, we're going to turn it over to John Egan from Genesis Fund. John, if you can even scope out even further and give any just overarching information. We have a really broad audience here, from developers to just interested, curious people. So if you could give just a little bit of just a general overview of sort of like what the historic tax credits are, and the role you might play, that would be super helpful. So at that, I will be quiet and let you start, John.
Great. Thanks, Alex. Thanks for having me on the panel today. I'm John Egan with the Genesis Community Loan Fund. We are CDFI, also based in Brunswick. Ryan and I could almost have a baseball catch. We're that close together in Brunswick, down the street. So my role and what I'm going to talk about today is a little bit about maybe translating some of what you just heard described about how the program works from Mike, who is an extremely valuable asset for the state of Maine. I don't think Mike gets enough attention for that, about how important it is to have user-friendly access with somebody at the SHPO office for this very powerful program. So thanks, Mike, for everything you do to make this program work. And then you just heard from Ryan, who is an investor, who is looking at the risks and the opportunities for a project that is eligible for this tax credit. My job at Genesis on the technical assistance side is to explain how these things work for developers, particularly if development includes affordable housing, which is our primary focus. I'll just start to pivot to Alex's request that the credit is generally something that you as the building owner, or your client who would be the building owner, is eligible to receive. And so the whole dynamic here is, from a tax perspective, that the building owner gets a federal and a state credit against their bottom line taxes. Many, if not almost all, of the building owners who might use this program probably don't have a tax obligation that equals anywhere near the amount of tax credits that they're getting. So if you're doing an old church and you're renovating it into a community center, and your eligible tax credits add up to, between the federal and the state, $900,000. If you as the building owner don't have $900,000 in actual tax obligation, this program becomes very valuable, because you can then turn to folks like Ryan and others to syndicate or to purchase and invest in your building, and you transfer that tax benefit that you have been deemed eligible for to the investor. And when the investor comes in, it's really important to keep this straight. They're not coming in as a bank. They're not coming in as a lender. They're coming in on your side of the table as an equity owner in the real estate. So even though they're going to have, Ryan and others are going to have underwriting requirements, and they're going to ask a lot of questions about your contractor and who's going to do compliance and all of those other typical investment activities, they're actually on your side of the table. And so it's important to realize that while you may have a bank lender for the construction loan, and then you have tax credit investors, it's important sometimes to sort of map out physically who's on what side of the table and how they're reacting to the various risks and dynamics in the deal. So anybody that's coming in to purchase tax credits, meaning syndicate, or they buy your tax benefit, they have to wait a number of years to get those credits. So they're going to pay you a little bit less than $1 for the dollar of tax credit, because they have to take it over time. So that's called a discount. And so you'll hear from investors, well, we can only pay this, we can only pay that. And that's where that comes from, is that they're pacing out how long it takes them to actually receive the tax benefit. And you're syndicating, or you're selling that. And so you're getting the cash up front, or at least when, the majority of it comes when the project is finished. But that's still up front in terms of the 5-year period. So it's important to realize these investors are coming in, they're joining you in a joint ownership of the real estate, or your client if you're an economic development person. It's the building owner that earns the credit, and it's the building that has to qualify. So those are important elements to keep out in front. And the opportunity for maximizing the value of the credit, and if you think about their equity coming in, and they actually invest in your real estate as the building owner, that's that much less money that you have to then go borrow and carry as a debt load based on the cash flow of the apartment, or the activities. So if you have 2 commercial spaces and 5 apartments, and that generates $10,000 a month, and you can afford a $8,000 a month loan payment, that may only get you a certain amount of distance towards finishing the project. But if you bring in the equity from the tax credits, you can actually borrow less money and do more work on the property. So it's a very powerful tool. And the distinction there is between borrowed capital and equity capital. Equity capital, you don't have to pay back. You have to provide the tax credit and a whole bunch of compliance, but you don't have to pay it back. And so when you leverage in equity to your deal, you lower the debt burden. And if you're running real estate, or if you're familiar with how real estate works, if you can lower the debt burden, it gives you a lot more flexibility on how it operates in year 2, year 5, year 10. So the value of the credit is to really lower the debt burden on the property, in addition to the historic preservation itself of preserving the historic asset, whether it's and that may be very important to your community, that you don't want to see the old school torn down and have a CVS put up there. You want to see an old school turned into senior housing. And so that's a way to do that. So from the perspective of what Genesis does, we help developers and building owners and municipalities understand how these tools work, so that we can maximize the value for the project, for the intended benefit and the intended purpose. Some of that has to be that we have to acknowledge and recognize what debt parameters that the lenders might have. They might have certain requirements of how you put together the debt that's in the project, and then pivot 90 degrees towards what the investors for these tax credits are going to require. Again, they're sitting on your side of the table, so they're a part of your real estate ownership, even though you're working with them like you might a lender. They're actually on your side of the table, and so their decisions are your decisions, and vice versa. And sometimes sort of keeping sort of who's got the lender requirements and who's got the investor requirements, we can help sort that out. So for the project to be attractive, Mike already mentioned and Ryan mentioned the requirements of the part 1, part 2, and part 3 is the actual certification of the project, meeting all of those requirements in part 2. That's a really important step. And there are many things in real estate development that can happen sort of A, B, and C, or D, B, and A, but the historic tax credit compliance is not one of them. You need to have part 1 first, and you need to have part 2 approval second, and you cannot start tearing into that building until you've got that part 2, because you risk doing something physically to the building that invalidates your part 2 approval. So it's really important to keep those linear steps in line, part 1, part 2, and then part 3 comes at the other end of the project when it's finished. I've been doing this for a while and have seen a large number of projects, and I've not seen yet in Maine, because we have a good crew, where the part 3 approval was denied because somebody did something during construction. And the reason why that is the case, why we've had a really good track record with that, is because the investors and generally the lenders involved require a consultant to be a part of that project all the way through construction. You're doing work on a historic building, and typical construction methods of tear this out, bring in the Sawzall or the sledgehammer, and let's just put up a new wall that's nice and straight, can't work. You have to sometimes look hard to find somebody who can do the plastering work on a wall that is buckled this way and slopes that way, and there's not a straight corner anywhere on it. But that's an important element in the part 2 of the approval to get the historic credits. So you have to do that work. So it's really important to have the contractor and the design professional and the consultant who's going to be certifying the adherence to the plan are all working together all the way through the project. This is part of the reason why historic projects tend to be a little bit more expensive, not a lot, a little bit more expensive than new construction, but new construction doesn't generate 45% equity on the dollars that you spend on the building. So it's a really powerful tool, and it can bring a lot of capital to the deal so that you can borrow way less money than you might normally do if you're building new construction. And so the Genesis Fund and our team here, particularly if there's affordable housing involved in the project, can provide some support and technical assistance and plug you into representatives in the marketplace who can do this. We're going to hear shortly from a consultant, Carter Jackson, who has lots of experience about how these properties comply, but that I can't stress enough how important it is to have, and Ryan mentioned it too, how important it is to have the right team. And that's part of what our work can do, is to help you get that set up. Genesis finance side, the other side of our organization, for projects that have affordable housing, can provide a bridge loan to these credits so that you don't have to syndicate them. You can take them yourself and use the refund from the state to pay off. I don't want to get into that. I'd need a chalkboard behind me to kind of draw all the arrows and boxes. But it is possible to do something with the state credit that doesn't involve selling them. You can actually take them and borrow against them and use the refund that the state of Maine gives you to pay off that loan. There's a few particulars there. It isn't quite as simple as I'm making it out to be, but it's pretty straightforward, and is another alternative if you can't find an investor for the state credit for a number of reasons. But there's we turn over a lot of rocks to try and find an investor before we go that route, because it's more efficient that way to have an investor in the credit. So I think I'll stop there. That's my 10 minutes, but just end with that Genesis is involved in these projects, and primarily because a huge percentage of these historic buildings are in great locations for adding housing, particularly rental housing, to your downtown communities. Almost all of the historic buildings in Maine, period, are in fabulous locations within their village or their city. So they make great locations for adding housing units on top of, or next to, or instead of commercial activity that may have been in there decades ago. And yeah, Alex will share our contact information. Be happy to chat with anybody. Great. Looking forward to the questions.
Thanks, John. I appreciate that. And we'll put the contact info at the, a little later into the chat. And if anybody ever needs it and you missed it in the chat, you can always reach out to me. I can share contact info as well. I really appreciate what you shared, John. I've worked with Genesis for years. You're all so helpful at leading people through processes and educating and being partners to folks like Mike Johnson and Ryan on different sort of parts of the process. So I think, you know, each one of you has such a unique role in all of this. And another person that might be involved, if someone's considering historic tax credits, is a consultant. There are a number of consultants around the state and nationally. Tara just rattled off a bunch over email. There are many. I happen to have met Carter Jackson over email. Carter reached out to me and was sort of the inspiration behind this webinar. And I was thinking there are a number of buildings in Lincoln County that I think would be great projects. So I thought we would put together this webinar, and it also gave Carter a chance to sort of introduce himself to folks as he's starting work here in Maine. So at that, Carter, I'll turn it over to you.
All right. Thank you very much, Alex. It's a pleasure to be here today. And, you know, as others have already said, the Historic Tax Credit Program is really special in that it promotes economic development and caring for the nation's built heritage. So it's a great thing to talk about. I'm going to share my screen. I have a few slides to share. Okay. So I'll provide a little background about myself. I recently finished my PhD in architectural history, and while completing my degree, I worked as a contractor for the Massachusetts SHPO, where I had a number of responsibilities, but one of them was to help review historic tax credit applications, much like what we've been talking about in Maine. So, you know, part of my job was to basically pick apart tax credit applications and then, you know, to make recommendations to applicants and to help get them over the finish line. I now run a preservation consulting business where in states like Maine, I generate tax credit applications for clients. I am seeking work in Maine. I haven't done tax credit projects in Maine before, but eager to do more. I am talking to you today in that capacity as a consultant. But one who knows the ins and outs as someone who has reviewed them on the inside. And my hope is that I'll be able to identify a few potential pitfalls and give you an overview of how tax credit consultants can make this process much less daunting. So I'm going to walk us through basically the three-step process that Mike outlined at the outset, but explain the role of consultants at each point. So a tax credit consultant is, you know, someone who typically has a degree in architecture or historic preservation, but most critically knows what the SHPO and National Park Service will look for when reviewing applications. They will work with your architect or engineer to help craft a project proposal for the rehabilitation that meets the Secretary of the Interior's standards. And they will complete all parts of the application. The first thing a consultant would typically do is some sort of preliminary meeting. They would help you understand whether your building is a good candidate for tax credits. The first hurdle really is to see if it passes or would likely pass the part one component of the application, which is to say, does it meet the requirements for listings on the National Register, or is it in a historic district already? And of course, as Mike mentioned too, there are other things that the project has to other qualifications the project has to fulfill. Does it qualify as a substantial rehabilitation if you're looking at a substantial rehabilitation tax credit? Which is basically to say, are you spending enough money on the project? A brief background on the National Register and basic requirements. In general, for a building to be listed on the National Register, it has to be at least 50 years old. And it has to look much as it did in the past. That is to say, it has to retain its integrity. We would also want to see if it could be argued that the building has some historic significance. If yes, then it's probable that the building's Part 1 application could be approved. So that's kind of our first hurdle. The second hurdle in a preliminary consultation would be determining whether your plans for the building's rehabilitation would be allowable, as Mike mentioned, under these standards, which are a set of federal guidelines for people pursuing tax credits that they must follow. And that's Part 2 of the application. So for instance, if you feel that you absolutely have to demolish or gut half of your historic mill building that you'd like to rehab, then no, your project probably wouldn't meet the standards. But if it's feasible to rehabilitate your mill while retaining its character-defining features, which I'll discuss a little bit more in a minute, then it's probably safe to proceed with beginning the formal application process. Your consultant should also begin conversations with the Maine SHPO at this time too. The Part 1 application is, of course, the first thing to submit. The consultant will write the official application and work with the SHPO to determine what might be necessary to get the building listed on the National Register if it's not already. It can take many months to get buildings listed on the NR. The process really requires a pretty extensive scholarly report that your consultant will typically write during the course of the project, as I said, if the building isn't listed or it's not in a district. So because of this, if you're waiting on your building to be listed, it's quite common for a Part 1 application to result in a preliminary determination of eligibility, which is enough to then proceed with the Part 2. And your consultant will continue working on that National Register nomination as things progress. It would make sense at this point to talk about the Part 2 application, but I think it's critical to touch on the role that tax credit consultants will play in the design development phase. Your consultant will help you ensure that all of your great ideas for your historic building are executed in a way that meets these standards. And I have included a QR code here if you happen to have your phone on you and want to scan it. It'll link to the National Park Service's list of these 10 standards. And they basically say things that are a little bit vague. Like Standard 2 says something about the alteration of features and spaces that characterize a property shall be avoided, which I kind of tell people seems a little bit squishy. But this is intentional because the people who wrote these standards realized that no two historic buildings are identical and no two proposed rehabilitations are identical. So the consultant will know how to identify the features that the NPS and the Maine SHPO will see as character defining. And they'll make sure that the need to retain these features drives the project design. And I'd say another way of thinking about that is to say, where architects who design new buildings will typically approach their design process from the outside in, maybe even sometimes, it might seem like they drop a building in from outer space on a piece of land. Historic preservation rehabs like these are more complicated, and then they require designing the building from the inside out. So the consultant will understand that, historic spatial arrangements that are significant in the building, the building's structural, its various ornamental details, its character defining features. And that's how the SHPO and NPS will think when they're reviewing your projects. So, it can sound like this could stifle a project, and I would say that that's really not the case. It's often, in my experience in reviewing applications, most often that consultants provide very helpful minor suggestions, things like tweaking doors, windows, materials, oftentimes bigger things, but smaller things that are easily overlooked and aren't impossible to change, but really important to getting those Part 2 applications approved. So, you know, all that is to say, if your preliminary meetings go okay, you think your project's viable, and you've gone through the design development phase and you feel like your project will meet the standards, the consultant will then submit a complete Part 2 application. So as others have said, that requires photographic documentation of the building, keyed to floor plans in a very specific way, a copy of existing floor plans, proposed floor plans, and I think perhaps most importantly, a narrative that describes the building in its current condition and clearly explains what is proposed in the rehab. And this portion has to be very specific and very detailed. And I think of it as the consultant making an argument for the decisions that you've made in your proposed rehab. And so, for example, if something that you're doing requires a larger intervention to part of the historic fabric of a building, maybe larger than what NPS and the SHPO might desire, the consultant should explain in the narrative why this is necessary, why all other approaches aren't feasible. So, for instance, they might say, you know, fire code requires us to demolish this historic feature. Our program requires this. We've tried all other options. This is the best thing. This is the best design route. So all of this should be made clear. An unclear narrative can really slow down a project. So you would then you submit the Part 2. Sometimes you'll get questions back from the SHPO or the Park Service requesting clarification. If the narrative is written well and the project is well designed, that should be minimized. And once the Part 2 is agreed upon, the project can proceed to the construction phase. Your consultant during the construction phase should monitor project progress consistently. It's very common for the scope of tax credit projects to change, for budgets to tighten, for goals to evolve, and that's built into how this program operates. The key is for your consultant to submit amendments as the project proceeds. And the amendments should also, they will be held to the same standards that the Part 2 initial application was held to. So as long as you're on top of that, that's really the key way to minimize any significant setbacks or to minimize the chance that your Part 3 application might be denied. So I have my little graphics here saying amendments come as the construction phase continues. And then we get to Part 3. And the Part 3, again, is very detailed photos of the building once it's complete. And the Part 3 photos should match what is proposed in the Part 2, and they should also match what you proposed in any amendments. And the SHPO and the Park Service will analyze that quite closely. So with the Part 3, Part 3 certification is issued, and that includes the IRS form that you must have to claim the credit on your taxes. And the NR nomination must be submitted within a certain window, and your consultant will be responsible for making sure that gets wrapped up as well. So I have one more slide, and I will be done. This is just a list of tips I've identified that are really critical for making this, what seems like a pretty intimidating process, go quite smoothly. And the first is obvious. You want to assemble a team familiar with historic tax credits, an architect or engineer who have done this before. As you can imagine, you'll want a tax professional who knows this system, a tax CPA, legal counsel quite often, and I selfishly recommend a preservation consultant. They are very useful. You'll want to initiate contact with the SHPO early and maintain contact throughout the process. Again, that's something your consultant should be doing. And you do want to make sure that Part 2 application is approved for construction. You'll sleep much better if you know that what you've proposed and what you've budgeted for will work within the tax credit requirements. And then, as I said just a couple seconds ago, monitor changes by submitting amendments. So that's all I've got. Thank you very much for having me. I'll be glad to answer any questions at the end of this. And of course, as Alex said, there are many preservation consultants working in the area, but I would be very happy to help anyone here with their projects. Thank you.
Not enough, Carter. So I think you might add the sum total up to 4. So
Okay.
not sure that I'd call that many. So glad to have you here.
Great. I'm happy to hear that.
Although we appreciate your candid diplomacy. So yeah, thanks, Carter. That was really, really helpful. Last but not least, we've heard from Mike, who's at the state level and deep in the trenches with applications, and then we heard from Ryan as an investor from that side, John Egan on a little bit of the support and sort of brokering and matching side of things, and then Carter as a consultant, sort of getting us through the process of doing all this work, and none of it would be possible without sort of the policy side of things and the advocacy. So next up, we're going to hear from Tara Kelly, who's the executive director of Maine Preservation. If you don't know them, they've got really cool website, and they do some really great work in the state. And so Tara's going to talk a little bit about what they do in terms of historic preservation in the state. So at that, I'll let you take it away, Tara.
Great, thanks, Alex. So Maine Preservation is a statewide advocacy nonprofit. We were founded in 1972, kind of as a nonprofit counterpart to the Maine Historic Preservation Commission. We do what they can't do, which is advocate for historic preservation in the state and also for money for them to be able to do their jobs. So among the other things we do, I'll just start by saying, we can help you with National Register eligibility. We have technical assistance that we provide to really any old building steward. So nonprofit, governmental, individual, private homeowner, whoever you are, if you have a relationship to an old building that you care about, we are here to provide assistance. We can also recommend professionals for your project team. Carter outlined who those folks might be. We have a preservation professionals directory on our website, but we could also talk to you in more detail about who might be located in your area specifically. Let's say if you're looking for a particular specialty tradesperson to do some work on your project. New and exciting development at Maine Preservation is that we are beginning to consider investments in tax credit projects. So on the smaller side, but we will be, I think, publishing more information about that once we get our act together. But we are looking to help to make projects happen by being investors. And then finally, as we started out by saying, we are an advocate. So one thing that is important to note about this program is that the Maine Historic Rehabilitation Tax Credit sunsets every few years. So the legislation is written that we have to re-up it every 5 years or so. So that is something that we've done with our colleagues and partners, including John and Ryan and others at Smart Growth and Merida, other coalition members who are pushing to make sure that this program continues to exist. And then also we also advocate alongside our partners. As Mike mentioned, we have 2 new pieces of legislation that have improved the tax credit this past year that just were funded in June. So LD 146 changed the timing of the credit so that within the first years you could take $10 million on the credit, so you no longer needed to phase projects of that size. And then also the rural boost, the 10% on top of the existing program, stacking on affordable as well. So I was just going to show you some other things that we're advocating for. And as you may have noticed, I had dropped some links in the chat, one about National Register, one about the Secretary of the Interior Standards, Mike's website where you can find out more about the credit in print, and then also some sample projects if you want to kind of get a picture, a glimpse of what these projects look like within their communities. So I had Bangor, a former bank and office building that is now housing and has a bar on the ground floor. We had Gardner Johnson Hall. That's a nonprofit owned project. It's an opera house. Bath, we have the Grant Building, a former department store that's now a co-working space. There's a former convent in Waterville that's housing. So there's a lot of great examples of different types of buildings, different uses, and different sizes and different project teams. And so you'll find some of that information in the narrative, and I'm happy if you reach out to me to talk you through some more information about any one of those. Obviously, Mike knows all about them, and I think Ryan and John probably are involved in every single one of those too. So anyway, what I wanted to share with you is that we do have another piece of legislation before the legislature. We're out of session right now, but coming back, it was carried over this year. This is LD 435. And this is a program to, sorry, I'm trying to advance to my next slide. Come on. There we go. Which would eliminate the sunset provision. That would make this program permanent. So we've heard about all the wonderful things that it does for its communities in terms of economic development, bringing vacant and underutilized buildings back into use, creating jobs, but we have to fight for it every 5 years. So we'd like to stop doing that and just agree that it's great and keep it on the books. LD 4035, we didn't hear very much about it today, but there is a small project credit, which you could read the details on the MHP website. This is barely used because the parameters for it are too small. So this is intended for a project that would not take the federal credit. So think about, you're not necessarily a developer, but you're a property owner who you own a building that your restaurant is in, but you can't use the upper floors. And so, it's just been underutilized, and, it's a little bit of a burden. The small credit is more intended for that kind of building owner. So we are pushing to, sweeten that deal a little bit more to make it better, more easily used. So increasing the base credit from 25% to 30%, and then changing the expenses. Right now, you can spend exactly between $50,000 and $250,000 in your credits, or sorry, in your qualified expenses. And we want to nudge that up to be up to $1 million. So that we're kind of capturing what's happening with today's dollars. I'm not sure that ever worked for yesterday's dollars either, because this was barely used, but at any rate, that's what we're trying to do today. And then we also want to create a homeowner credit. 28 other states have a historic homeowner credit. Maine's income producing credit works great, but we want to see that adapt to private property owners. So they have to be owner-occupied residents. So this is not for turning houses into Airbnbs. It has eligibility for ancillary structures. So if you're thinking about it's not just your house, but maybe you have a carriage barn or a garage that needs rehabilitating. The expenses need to be between $5,000 and $250,000. And it does have an income cap on this. So your adjusted gross income has to be at or below $120,000. Included within the eligible expenses are energy efficiency and resiliency upgrades. And you can get an additional 5% boost for properties that would have an affordable unit provided to a renter at or below 100% of area median income, or for properties that have been vacant for more than 5 years. So one of the things from a planning perspective that we were designing this program to do is, for one thing, to work with energy efficiency and resiliency so that you could take advantage of things like Efficiency Maine, but then do it sensitively to your historic home. But also knowing that LD 2003 had passed, that there are folks who are looking to increase density by adding accessory dwelling units. Why not do that in existing historic fabric already in our communities? And so that's where the booster really is trying to incentivize that people use their existing buildings to do that. So I'll stop there. I'm happy to answer questions, and thanks for letting me share what we do.
That's great. Thanks, Tara. I really appreciate that that overview, and especially some of the policy stuff that people might not be aware of. So all right. So thank you to our panelists for everything they shared. And at this point, I'm going to open it up for questions. Like I said, feel free to you can use your raise hand. You can actually physically raise it, or just use the signal, or you can put your question in the chat. I did see there were some questions earlier in the chat, and it did look like folks did get their questions answered. I think Ed asked a question. Does the building need to be individually listed on the Carter, do you want to just address that so that everybody can hear the question in the recording?
Sure. Let me pull up. Yeah, the question was just from Ed. Does the building need to be individually listed on the National Register of Historic Places, or is it sufficient for the building to be among those specifically listed in such a listing for a historic district comprising multiple buildings? That's a good question. So what Ed is after there is the idea that every single building that's eligible for tax credits must have its own individual nomination, which isn't the case. If you're fortunate enough to have a building you would like to get tax credits already in an historic district, and it can be considered a contributing resource to that district, which means when the district was generated, it would have had a period of time that the buildings to contribute to its historic integrity had to be built within. So your 1985 like Walgreens or something would not contribute to the historic district, but a building built within the period of significance that's been defined, your post office from 1920, that building would contribute most likely and would be eligible for tax credits.
Great, thanks, Carter. I see that John Egan, you have your hand raised.
Yeah, I wanted to ask Tara, in preparation for this, I went and looked at LD 435 and I found on the Maine legislature that it was passed, but did it not get to the governor's desk, or
It's
what's
not
the
the
actual
governor's,
stat?
it didn't get funded.
Oh,
So
it didn't get funded. Okay, so it didn't make the appropriations table.
it did not get
Right.
through the appropriations table. So I realized I wanted to stop talking, so I didn't share kind of the next action steps that I was gonna share with you all, which is that the kind of target for advocacy, if you would like to be helpful in supporting LD 435, is to reach out to the members of AFA, which is Appropriations and Financial Affairs, also Senate leadership and House leadership in the legislature. So if they represent you, that's even better, because that means that they're listening to you as a constituent. But just generally speaking, hearing from any Mainer saying that you love this program and want to see it improved would be tremendously helpful.
Thanks for that, Tara. And Tara's put a ton of links in the chat. It's been so useful. So if you didn't look at those, please do. I will be sending notes out to those who attended today, and those who RSVP'd, along with anything in the chat that's relevant, of course, and then also contact information for our panelists. We also, I put those in the chat as well just now. But Mike, it looks like you might have a question or a comment.
Yeah, I have a answer to a question nobody asked. I forgot to mention. So I wanted to just talk about what a qualified rehab expense is, and it's essentially anything you do on a historic building, and it mainly excludes just site work, like parking lots, landscaping. It excludes new additions to a building. And it excludes furniture, basically things you can carry out of the building, but anything else you do on that building, including insulation, electrical work, if you need drywall somewhere, plaster repairs, slate repairs, new roofs, all that stuff qualifies. HVAC systems, sprinkler systems, that all qualifies. A huge component of this program is to get these buildings up to code. So I just wanted to mention that.
Really helpful.
Soft costs are eligible as well. So if you have to pay an attorney or an architect or a tax advisor, those are all eligible. The other big one that's not eligible, unfortunately, is the acquisition. So you have to be mindful of where that is. Somebody mentioned earlier the importance of making sure that you're spending more money than you have in it already. So if you bought the building last year for $100, you have to make sure you spend at least $101 on renovating it. If you go and try and do a historic renovation with $75 in renovation and you paid $100, they're not going to let you take the credit.
Go ahead, Carter.
I just wanted to add another point onto the question that Ed asked and I was responding to. And maybe Mike can speak to this a bit more, but regarding districts, the requirements for a building to be individually listed on the National Register are higher. Its integrity has to be greater if it's going to be individually listed. If it's going to be a building in a district, the National Register is most concerned with its external appearance. So for buildings that don't have enough interior integrity, one avenue to pursue is trying to get the building listed in a district. Of course, that requires someone and a consultant to write the nomination for a district, which is a bit more work, but it can be done.
Thanks, Carter, for that clarification. Aside from our panelists, are there any questions from the audience? I have some, so I can pepper you with them if no one else. I can't imagine there are no questions, but I guess just sort of going back, Lincoln County, we've got some larger towns like Waldoboro, and then we have, much smaller towns like Bremen and Edgecombe. And Tara, you shared some examples of projects. They're mostly in bigger cities. So can someone tell us a little bit about, what is the criteria that's used to review? Are smaller towns using these tax credits? Can they? Any thoughts on that?
I'll let my colleagues who know better than me follow this, but I think that the general issue is really size of the building, right? Because you need to have a big enough investment to attract a federal investor to take those federal credits. Somebody has to have a large enough tax liability. The project has to generate enough to be expensive enough. So usually that's a bigger building. That's changing as construction is more expensive. It's more expensive in smaller buildings too. But that's one of the reasons why, in terms of our policy, we were trying to improve the small credit, because that works better for smaller buildings. But please, any of my other colleagues jump in and correct me.
Yeah, I mean, I would say that, a big part of the reason, was it LD 1755, I think, passed, was to kind of help boost housing in rural communities, clearly. But, aside from that, we've already had a lot of projects in almost every county in the state. And it's towns like, Unity, Thomaston, Rockport, Rangeley, Skowhegan, Norway. I love seeing those projects in smaller towns. Let's see what else we have. North Berwick, Lisbon Falls. I mean, I could go on and on, but I mean, I usually document all that in the report. I don't have time to open up the report and get to this right now, but it's a lot of communities in the state have used this credit, and I think as John was saying, these buildings lend themselves to this because they're already tied into infrastructure. They're already in these downtowns. They're excellent. They make excellent apartments. Coney High School in Augusta is a great example. I mean, it's near a pharmacy, it's near a grocery store. All those things make a big difference, and they're very important to housing, particularly for people that may not have transportation. So, I think it's a great program. And, all these, and like John was saying, we've not had any projects come through this program and not end up getting certified at the end. And most of that is because of the expertise of all the people on this panel and others as well who may not be on this panel. Everybody is extremely experienced in this, and they want to help, and they want to help get these properties back online and help keep the character of our state going. And I think it's just a great program.
I wanted to add that, like, another limiting factor that is not remotely insurmountable is just where National Register listings and districts are. So we have to make sure that like the building has to be eligible for the program. And so if there is not a National Register district or listing already, that's part of the process you have to go through. And so as Carter mentioned previously, it's a higher standard for an individual building, and that may be worthwhile for a large project as a developer. Within a district, the integrity can be lower, but you also have to have your neighbors agree to be part of the district, which I will say also here emphatically that National Register listing is not burdensome. It is just opens you up to grant programs and to this tax credit program, and then also kicks off a process if the government has any impact on historic resources within that location. But that's just another issue that might speak to why we see it in fewer of the smaller towns.
Great, thanks. I appreciate that. Certainly helps answer that question. There was a question in the chat. Can Old Sears or Aladdin homes, which are those kit homes, be eligible for tax credits?
Say, I mean, I think he's referring to kit homes from, I think, around the 1920s, 30s or so. And yes, I mean, we do have properties that are kit homes that are listed in the National Register. So yeah, they would qualify.
They would qualify only if they're income producing in the existing program. If they
Right.
are a residence, if they are a residence for an individual that does not have any income producing component to it, there is not an existing program in Maine for tax credits.
So if it's a rental, if it's used as a year-round rental, it can be used for that. If it's a short-term rental, would it qualify?
Yes.
As
Yeah,
long
this is very-
as long as the balance of the time that it's not in use as a short-term rental, it's occupied by the owner. It has to be short-term rental the whole time.
Thanks so much for clarifying that, John. There was another question about if you can use any of the historic tax credit for brownfield cleanup.
I would say no. I don't know. I mean, not unless part of that brownfield cleanup involves asbestos inside of a building, that would qualify. But I mean, if you're just cleaning up a site, then no.
I guess I had a question that has been posed to me in the past, and it's around sort of the constraints or challenges of going through this process. Aside from it being pretty bulky, are there any? I think, Mike, when you and I talked on the phone, I mentioned there's sometimes some conceptions that going through this process limits what you can do with your building. Can you or anyone else talk to that?
I mean, it can. I would say the owner and the owner's project team really have to make an effort to fit their project within the standards in order to use these credits. So yeah, I mean, it does. I think it would be very difficult to take a barn and convert it into a bed and breakfast or something, with insulation and that type of thing. So, one of the first standards is, you have to have a use that's compatible with the historic property itself. And that's a very important overarching theme of the standards. So you're not putting a round peg into a square hole, so to speak.
Yeah, that's true. I mean, you do also see projects like historic schools be turned into affordable housing. There are ways to make buildings that ostensibly have nothing to do with their new intended purpose be viable. You get into problems with what do you do with big volumes, like in a school, if you have a historic gymnasium. But I've seen people find ways around it. I think it makes, being part of the tax credit project or process does make, I think, for a higher quality product at the end of the day.
Yep, that's a good point, and it aligns with what we heard earlier about sort of the return on the investment being higher, especially than like a new build. There was a follow-up comment just that regarding the brownfield cleanup. It was referring to Mason Station, and I didn't know if you had any follow-up question with that. The name is Wiscasset Committee, so I'm not sure if that's something you want to come off mute and ask.
Alex, thanks for organizing this. I'll
Oh,
probably
yeah,
I'll speak
sure.
to you.
That's Aaron, the
Oh,
Economic
yeah.
Development Director for Wiscasset. Great to hear you.
I guess I can speak to you offline. I don't want to take everybody's time off on my little pet project, but it sounds like it might be able to. So thank you.
Yeah. Sounds like we might want to hook you up with some of our panelists just to have a chat.
Yes.
Sounds good. I think I did have another logistical question about an application and a project, and any one of you can answer this, sort of just give an idea of how long the process might take. So like if I applied today, how long would it be sort of before my application is done and the project is complete, just to get an idea of how long this stuff takes?
That's very difficult to answer. I mean, we have a variety of different sizes and shapes of buildings and in a variety of different conditions. I would say, it depends on so many different factors. I mean, like I said, we have 30 days to review each part of the application and the part, so it's like 60 days per application part and 60 days for any amendments that get submitted subsequent to the part two approval. So there's that, but then oftentimes the biggest driver I would say is construction schedules and contractor schedules, sometimes architects, sometimes, it's a variety of things. And John and Ryan may have more to add to that too, for that matter.
Yeah, I'll just add, I mean, when applications come to us, for the state tax credit side of things, a lot of times, much of what goes into sort of that part one and part two process, are pretty well baked. So at that point, it's ultimately, as Mike touched on, the construction, right? Finalizing that budget, getting, the investors on board, finalizing what their pricing will be, and ultimately working through sort of the logistics of, the documentation piece of it, because it is, a special purpose entity, right? The investors are admitted as members into the project. So it's, a different sort of transaction, compared to just traditional, real estate financing. So it tends to take a bit more work, which is another reason why the project team is, extremely important, right? The accountant, but obviously the legal team, the attorneys on both sides will definitely, want to find an attorney that's familiar with the program as well. So in each deal, it's a tough one to answer because each project has its own sort of nuances in, if it's an affordable housing project, and perhaps there's a Maine State Housing Loan Program involved, those often take quite a while to sort of get across the finish line as they work through their due diligence. So it's, yeah, tough one to answer. Each project is unique.
Thanks for that. That's what I suspected you would say, but some of the elements are very helpful to hear. One other question that often comes up, can a town use historic tax credits for a building that they own?
I came across this, and I'm trying to remember where it was. I think it was a school district, so it wasn't a town, but it was a school district municipal entity. And because the investors, if you're syndicating the credits, meaning you're going to bring in equity capital from an investor, they have to join the real estate entity. And they're not about to join, school district 205 or whatever the RSU number is. So quite often, in fact, I'm pretty certain it's almost required, the tax advisor to the deal, whether it's the school or the town's attorney or the investor's attorney, is going to say, put the real estate into an LLC And that way everybody can join the LLC without all the hair and craziness of municipal owned entities and who's this investor in our town asset, blah, blah, blah. You can have it so that after the tax credit compliance period, the asset can go back to whoever it was that owned it previously. But for a minimum of 5 years plus a few months, it generally makes sense to have the property owned by a single purpose entity, and you can have participants as members in that entity, but the actual real estate is owned by an LLC or an LP.
That's so helpful. Thank you so much, John. I appreciate that additional context. So that's super helpful. I didn't have any other questions. I've run through all of mine. I can always think of more questions, but it's 4:27. I did want to put it back to the audience to make sure there weren't any final questions folks wanted to ask. And any final closing comments from our panelists?
I just wanted to provide some context to the question around federal cuts. There are a number of different ways that federal funding touches this program. One is the credit itself. I have not heard anything about the credit itself going anywhere. There is funding that goes to the National Park Service, which is a very large government agency, but the technical review team, I don't believe, is experiencing any cuts, but how that's to say that cuts elsewhere within the agency could affect this program is unclear. And then the Historic Preservation Fund is the funding that goes to our state and tribal historic preservation offices. So that's Maine Historic Preservation Commission. That's money for Mike, but also for the rest of them over at MHPC. And they had not received their funding from fiscal year 25, which was enacted by Congress last year. And that was recently released, but if they had not gotten that funding, MHPC would have had to let go of staff by the end of next month, which would mean that those tax credit reviews would not be happening any longer. In terms of the upcoming federal budget, the House has included level funding for HPF. That's moving on to Senate. If you would like to call Senator Collins and tell her that you think that the HPF funding is important, please go ahead and do so. Follow along in, you can visit Maine Preservation's website, join our email list. We will keep you updated on advocacy, locally at the state level, but also federal advocacy when we need your help to make sure that funding is coming both to the tax credit program and to the people who make it happen. So we can keep you posted that way. And I'll just throw our website into the chat.
Thanks, Tara. Appreciate that. Well, it is 4:30. I want to thank everybody who served on this panel today. We have an incredible team of people in Maine that can help out with historic tax credits. Please reach out to me. I'm Alex Zaparo at Lincoln County Regional Planning Commission. I'm your economic development person for Lincoln County. You can always call me and I can point you in the right direction, or feel free to reach out to our panelists directly. But thank you, everybody. And if you have any ideas for other webinars, please let us know. At that, I'm gonna end